Have you ever wondered how the rich keep getting richer? It's a question that's crossed many minds. The secret, dear listeners, isn't locked away in a vault or buried treasure chest. It's the magic of investing. Investing is often perceived as a game for the wealthy, a playground for those with stacks of cash. But that's a myth we're here to debunk. Investing is not just for the affluent. It's a tool, a strategy that anyone can employ to grow their money. Imagine this. Every dollar you have is a tiny worker. Now you can let them loaf around, or you can put them to work. When you invest, you are essentially hiring your dollars to go out and make more dollars. This is the concept of your money working for you. You see, the rich understand this. They know that every dollar sitting idly in a bank account is a missed opportunity. So they put their money to work, investing it in stocks, bonds, real estate, and businesses, creating a cycle of wealth accumulation. This might sound intimidating, particularly if you're new to the world of finance. But remember, every expert was once a beginner. Investing isn't about overnight success or getting rich quick. It's about patience, persistence, and informed decisions. It's about understanding that the market will have its ups and downs, but in the long run, your investments will grow. And the best part, you don't need a mountain of money to start investing. Even small amounts invested consistently can grow into a significant sum over time. That's the power of compound interest, but we'll get to that later. Investing is a journey. It's a path to financial freedom that's open to all, not just the wealthy. It's a way for you to take control of your financial future, to build wealth over time, and to make your money work for you. So, are you ready to unlock the wealthy secret and set your dollars to work? Now let's dive into how you too can start making your money work for you. First things first, let's understand the basics of investing. When you invest, you're essentially putting your money to work for you. There are two primary ways to do this: buying a piece of a company, known as stocks, or lending money to a company or government, known as bonds. Let's start with stocks. So when you buy stocks, you're buying a tiny piece of ownership in a company. If the company does well, your stock can increase in value. If the company does poorly, your stock can decrease in value. The goal is to buy low and sell high, but there's no guarantee of that happening. Now let's talk about bonds. When you buy bonds, you're lending money to a company or government for a set period of time. In return, they promise to pay you back the principal plus interest. The risk here is that the company or government could default on their loan, and you might not get your money back. So investing involves a degree of risk. But here's the thing: no risk, no reward. The potential for higher returns comes with a higher risk. However, you can mitigate this risk through diversification. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. It's a way of evening out the risks and potentially increasing your chances of investment success. Think of it like a balanced meal. You wouldn't just eat potatoes for dinner every night, right? You'd want to mix in some protein, vegetables, and grains. It's the same with investing. You don't want to put all your eggs in one basket. By investing in a mix of stocks, bonds, and other types of assets, you can help protect your investments from major losses. Now that we've got the basics down, let's explore some popular investment options. Ever heard of ETFs and index funds? These are some of the most popular investment options today. Dive into the world of investing, and you'll soon encounter the terms ETFs and index funds. They might sound complex, but they're actually quite straightforward. ETFs, or exchange-traded funds, and index funds are types of investment funds, both of which offer a way to invest in a broad market segment rather than individual stocks. So what's the appeal of ETFs and index funds? Why are they so popular among investors? Well, first let's talk about diversification. When you invest in an ETF or an index fund, you're essentially buying a tiny piece of each company in a particular index. This means you're spreading your investment across a wide array of companies, industries, and potentially even countries. This diversification can help reduce risk because you're not putting all your eggs in one company's basket. Second, ETFs and index funds are known for their low fees. Unlike actively managed funds, which require a team of analysts and portfolio managers, ETFs and index funds simply aim to replicate the performance of a specific index. This passive management approach results in lower operating costs, which are then passed on to investors in the form of lower fees. Third, ETFs and index funds offer ease of trading. ETFs trade like stocks, which means you can buy and sell them throughout the trading day at market prices. Index funds, on the other hand, are bought and sold at the end of the trading day at a price equal to the fund's net asset value. So if you're seeking a simple, cost-effective way to invest in the stock market, ETFs and index funds might be just the ticket. They offer a way to gain exposure to a broad market segment, diversify your portfolio, and keep costs low. So, ETFs and index funds offer a simple and effective way to invest. But how do you actually start? Getting started with investing is easier than you might think. The first step is setting up an investment account, and voila, you're on your way to becoming a boss investor. Let's walk through the process together. First off, you'll need to choose a broker. This is the company that will hold your investments for you. But not all brokers are created equal. Some charge high fees, which can eat into your returns over time. That's why it's crucial to select a low-fee broker. By doing so, you keep more of your money working for you. Remember, the goal here is to maximize your returns, not the brokers. Once you've chosen your broker, you'll need to open an account. This typically involves filling out some paperwork and providing some identification. You'll also need to decide what type of account to open. There are many options, from individual brokerage accounts to retirement accounts like an IRA or 401k. The right choice depends on your financial goals and circumstances, so be sure to do your research. Now that you've got your account open, it's time to fund it. This is where the concept of dollar cost averaging comes into play. You see, investing isn't about throwing a lump sum of money into the market all at once. Rather, it's about investing small amounts consistently over time. This approach allows you to spread out your purchases, buying more shares when prices are low and fewer when they are high. It's a simple, effective strategy for mitigating risk and taking advantage of market fluctuations. The final step, start investing. Buy shares in ETFs or index funds, or individual stocks if you're feeling adventurous. Stick to your plan, stay consistent, and watch as your wealth expands over time. With your account set up and a consistent investment plan, you're ready to start growing your wealth. So, what are you waiting for? The world of investing is at your fingertips. Let's seize the opportunity together. Now, let's talk about the magic ingredient that makes investing so powerful: compound interest. Imagine you're baking a cake. The flour, eggs, and sugar are your initial investment. The heat of the oven is the interest rate. And the cake? That's the sweet result of your investment, growing bigger and tastier over time. But here's where it gets interesting. With compound interest, your cake doesn't just grow in size, it multiplies. How? Well, it's all about the magic of compounding. You see, compound interest is earning interest on your interest. It's when the interest you earn on your investment starts to earn its own interest. It's like a snowball rolling down a hill, getting bigger and bigger as it picks up more snow. That snowball is your investment, and the snow it's picking up, that's the compound interest. But where does this magic really shine? It's when compound interest is paired with consistent investing. Let's say you start investing a small amount each month. With each passing month, not only does your initial investment grow thanks to the interest, but the interest you've already earned starts to earn its own interest too. This leads to exponential growth over time. In the world of investing, time is your greatest ally. The longer you leave your money invested, the more time there is for compound interest to work its magic. And this magic isn't just for the wealthy. Anyone can harness the power of compound interest, whether you're investing a few dollars or a few thousand. The key is to start as early as possible. The sooner you start investing, the more time compound interest has to work its magic. And the more money you'll have at the end of the day. That's the beauty of compound interest. It rewards patience and consistency. And there you have it. With compound interest and consistent investing, you're well on your way to building wealth like the rich.